With all the chaos in the stock market, quality companies are being overlooked. And that gives huge opportunity for investors like you and me to step into really high quality names and get a fantastic price for some really great long-term assets. Today, we're going to be talking about a company that I think could potentially be in that category of a high quality company that's been overlooked. It's in the Canadian oil and gas sector. It's called Whitecap Resources. Today's question, is this a really high quality, strong value buy right now? Or is this a yield trap whose dividend offering at 8.9% is simply too good to be true and that won't be able to sustain that dividend for the long term? Welcome to Go and Lunch Investing. My name is Liam. On this channel, we love to talk about investing in Canada. If that interests you at all, please do like the video, subscribe to the channel. It makes a massive difference and it doesn't cost anything. In order to show you some of these numbers, I'm using finchat.io. Fantastic service. I recommend you use them. Some of the numbers that FinChat uses are not the same as what I've seen everywhere else. So I'm going to be going with what I've seen as sort of the default number specifically for dividend yield, which is that 8.9% number I referenced earlier. FinChat has it as a different number. I don't know exactly why. It could just be like a calculation error. But let's talk about the dividend first and foremost, because like I said, really the question here for most investors, 8.9% dividend is fantastic. So that's sustainable. If they can pay that out long term, that is a great reason to own this company, especially if they're at a real discount right now and you could actually see the share price rebound to where it was just a year or two ago. Now, when we're looking at payout ratio, some of the numbers that I really like to look at include payout ratio, it includes free cash flows, and then it includes net debt. So we're going to talk about those numbers. Again, I'll show you them from FinChat. Payout ratio right now is sitting at 53.4%. So about half of their earnings are going towards paying out their dividend. The rest is going towards other activities. Now, I think this is great, but we have to remember that their last year's earnings that we're using to make this calculation are going to be better than 2025. They are a Canadian oil and gas company, so they do depend to a large degree on the price of oil and natural gas, both of which have come down in the last month or so with all of the chaos and the fear of recession. So just be forewarned. 50% though leaves us a good bit of buffer room. If it was 70%, I would be worried. 50%, maybe not so much. Free cash flow, also super important number. That's a number that can't really be messed with, right? Earnings, you can do some financial wizardry to make the earnings number look better. You can't mess with free cash flow. And the free cash flow right now is at $700 million. Currently, their dividend is costing about $433 million. So that means that there's an extra about $300 million in there of buffer room that they've been using for other activities like buying back debt and buying back shares. Both of which are fantastic opportunities for this company at these share levels and at the sort of, potential cost of that debt being sort of renegotiated down the road, right? If you're looking at where they probably took that debt out, interest rate environment in the 2020 era versus 2025, even though it's not as high as it was 2 years ago, still going to be a little bit more expense. So them paying back that debt is awesome. And obviously buying back shares while the share price is low is a fantastic way to return value to shareholders. Speaking of debts, companies with large amounts of debt that pay out a huge dividend are something I personally find frightening. A great example of this, BCE. I've talked about them on the channel. I worry that their amount of debt is going to cause them to spiral. And if they continue to try to pay out the dividend, they don't pay off the debts, they could put themselves in a really bad spot. Now, these guys have done a pretty good job of paying down debts. They've paid down hundreds of millions of dollars each year for the past couple of years. I think it shows that clearly they're in a good position. Also, their debt to equity ratio looks pretty much fine. So with the numbers looking the way they do, I think Whitecap is clearly able to pay their dividend. One of the things I have noted down though, does that story change as the WTI price drops? And I think it does, but it doesn't drop or change too much until we see WTI in the range of like 55 and below. That's when I would start to be worried about the dividend. That's when I would be worried about their ability to sort of continue to cash flow. That's when I'd expect management to maybe cut back a little bit. Now, I only think we see that number if we get both production increases and recession, or of course, if we get a serious depression. Just my thoughts. Dividend looks pretty safe right now. It is dependent on commodity. Anything that's dependent on a commodity has a good and a bad potential scenario coming in the future. I am pretty bullish on oil, but I am bearish short term. Just wanted that to be out there. Let's look at a couple other things here. Really important you understand the story of Whitecap. Now, when we're investing in companies like this in the Canadian oil and gas space, a lot of them kind of feel the same. right? Like apart from sort of how efficient is a company, what assets exactly do they own? A lot of these companies are treated pretty much the same by investors, particularly retail investors, right? It doesn't really matter to us as retail exactly how they produce oil and gas. What depends, or what matters for us, what our investment depends on, is how efficient they are, how much cash flow they generate, and how much they're going to pay us. Now, these guys specifically are light oil, condensate, and natural gas play. So if you're specifically investing in those kind of areas, that's good for you. Natural gas specifically is a pretty popular area right now. I'm incredibly bullish on Canadian natural gas, as you guys know. But the big story with them is really all about their recent merger. Now, recently they merged with Veren, which is another, similar sized, I think almost exactly the same size or just about the same size as of the merger. And they're kind of coming together and they're going to create what is, I think, the seventh largest oil and gas company in the country, the seventh largest player. And that gives them a couple of key advantages. And I have it listed here straight from what they say. So first thing, they claim after this acquisition, they're going to have 50% of their oil production hedged at $85 Canadian, which is pretty relieving for those of us worried about that short-term oil bearishness, which includes me, right? So that gives them a little bit of buffer room. So even if oil drops dramatically, their average price is actually going to be higher than WTI, right? Because as WTI drops, you're going to find the average price between with the 50% they sell at market price and the 50% they sell at their hedged price. Another thing they say right here, they're expecting to save $150 million in the next year or so. And to do that every year, thanks to the acquisition, thanks to the sort of synergies, thanks to all of the operational efficiency. And the final really interesting thing they say right here is that they expect to be far more investable by large institutions. One of the things I think that holds back smaller companies is that in the public markets, you don't want to own over a certain amount because then you become an insider. There's all sorts of rules. So the larger a company like this is, the more investable they are from larger funds, right? If they're a $7 billion company and you're a $500 billion fund, you can only own a tiny sliver of that company without hitting that 5% or whatever your fund limits you to. Once they become, 30 billion, as it looks like they're going to be, right? A lot more investable. There's a lot more money you can put in without hitting that cap. There's a lot more opportunities, a lot more stability, right? They're going to be more stable. And they sort of hit all these sort of metrics that institutional investors care a lot about. It doesn't really matter to us as retail investors, right? It's not like I'm going to all of a sudden own 5% of a company. That's unrealistic for me, but it does help them out a little bit. Another thing I think it does, it puts them at a size and scale where they own some really, really desirable assets. They own some long-term assets. They say that they're going to be able to pay out their dividend into the 2030s with the assets they own right now. They have sort of planned and drilled and explored, right? They're in a really good spot. But we're not the only ones that might be interested in investing in this combined company now that they've done this merger. They also are now a much more attractive target for acquisition. You have to combine or do two different acquisitions with two different management teams to acquire each sort of half of this business a year ago. That's a lot more hassle. That's a lot more work. That's a lot more due diligence than doing one acquisition with the whole firm. Am I saying that's happening right away? No, but I do think it's pretty crucial that opportunity is out there. And I am far from the only one who said stuff like this. I've heard industry insiders saying stuff like this, investment gurus, people that talk about the space every day have mentioned Whitecap's name in the world of potential acquisitions. And that puts a pretty hard floor under this stock price, which is a really nice thing as a dividend investor. I'm trying to collect the dividend. If the stock starts dropping dramatically, yeah, my dividend yield goes up, but eventually I'm going to want to sell those shares. If suddenly somebody's going to come and buy in at a 30% premium, well, even if the stock drops 30%, all of a sudden I'm back to net even with my dividends now collected. Would I rather this company simply continue to earn me money in the long term? Yeah, right? From an investor's perspective, I think that position is pretty clear, especially with a 9% yield. Imagine the amount of capital you could put into this company and then just see it snowball so fast. But either way, having that hard floor, really valuable for a sort of risk conscious investor. So now let's talk about my bull and bear cases. And again, I'm going to reference my notes for this. Bull case for this stock. I think there's a couple key pieces. First and foremost, share price makes a lot of sense at $60 WTI. Now think about what the share price should look like at $70 or $80 WTI, right? The numbers right now look okay. They look fine. They can pay everything off. As of their most recent financial statements, things look okay. If we see WTI materially rebound this year, all of a sudden you're gonna need to see the share price also rebound to keep up. And the thing with companies like this is that basically every dollar past their cost basis is pure profit. And so if they're profiting $10 a barrel, the difference between $10 and $20 a barrel is double, right? And then 20 and 30, now we're talking triple, right? And so the share price typically follows that kind of percent gain. So if you see WTI go up $10, you're not going to see the share price go up, whatever, 10%. You're going to see it go up 100%, right? Just obviously theoretically, but there is a huge amount of potential expansion if we see WTI rebound. I'm not saying that's going to happen short term. Remember, they are 50% hedged for the next year. But if we're talking 2026, we see, everything kind of rebound. We see shale oil not increase production this year because of the low cost or the low price, for WTI. And then all of a sudden there's a lot more demand, and right, we never know exactly what's going to happen in the future. And I think while the stock is priced pretty fairly right this second with the kind of environment we're in, if we're in a better environment in a year, I would expect to see the stock dramatically higher. Another thing that I'm seeing on here right now is that they have solid dividend growth prospects. They're claiming 15% dividend growth through 2030. So that could mean some really, really solid dividend growth numbers. You're starting out at about 9%. And if the stock continues to go down, but it doesn't hit that kind of critical level, right? If we see WTI fluctuate in the 60 range and investors get a little bit spooked, you could see the stock price go down a little bit. You could get an even better buy price. You could be buying in at like a 9.5%, 10% dividend. And then you see WTI rebound, you see the stock price rebound. You're still getting your dividend. Your yield on cost remains at 9, 10%, but all of a sudden you've now made 30, 40, 50% in actual market gains, in capital gains, which would be huge. And finally, I think there's a huge potential for buybacks here. One of the things I've heard speculated about by like serious institutional investors in this space is that since there's not a lot of room for capital expenditure in 2025, there's all this uncertainty. You can't really invest a huge amount in big future projects while everybody's got their sort of hands up going, I don't know what's happening, but you can buy back shares. And if your shares have dropped enough that you are, from a sort of valuation perspective, all of a sudden really attractive, if management believes that, hey, our company is now incredibly undervalued, makes a lot of sense to have some of that return of capital in the form of buybacks. And I think they are positioned to buy back a lot of shares. I've actually heard some pretty influential names say that they could be buying back like double-digit percentages of the company in the next couple of years with the price of oil staying where it's at. Now, again, if you double the price of oil, or not double, pardon me, if you go up $10, you double their profitability, all of a sudden you can double that buyback. And now we're talking like 20, 30, 40% buybacks, which obviously would boost your ownership stake dramatically, boost the value of your shares dramatically. I don't need to tell you why a buyback is great. Bear case, really important that we understand bear cases, right? As an investor, we look at all the bullish stuff, we sort of get really excited, but we have to remember the risk, because without that, we can't really do a reasonable risk reward calculation for ourselves. My bear case here is pretty obvious. The first thing, commodity risk. What if we see the price of WTI drop below 50 for an extended period of time? Right? If the price of oil is dropped for any elongated period of time, I'm talking years, not months, years, we are going to see the dividend cut. Plain and simple. They are going to have to cut the dividend because that is how you protect the business, and that is their fundamental job as management. They will cut the dividend. You will be in a position where the share price also drops materially. But remember, these guys do have a floor under them built in by the ability to buy back shares and by the ability to be bought out by a larger player. Because they own these assets, because they're long-term, because they're super high value, because they're really quite instantly accretive at their certain levels, right? You could see somebody swoop in and buy them. I also think that there's a real chance that the merger costs more and introduces less synergies than has been promised. I feel like this is a constant thing when we talk about big mergers. Companies are so excited to do them. They talk to their shareholders. Hey guys, we're going to have all this great stuff happen. We're going to save, what was it, $150 million a year. starting this year or next year or whatever, within a year, whatever that means. But what if that doesn't happen? What if instead we spent all this money merging these two companies and we see like, I don't know, 20 million saved in the first couple of years? Well, all of a sudden it looks like we spent a bunch of money. We haven't actually seen a huge amount. Shareholders from either side are getting grumpy at each other. You know, if you're a new shareholder, if you're in my position where you're looking to buy into the consolidated company, maybe you don't mind, but obviously that's a problem. And that could also keep the share price low, right? People are disappointed. All of a sudden they're selling out of their shares, right? Maybe former Veren shareholders don't like what's going on. Former Whitecap shareholders don't like the Veren assets. Whatever might happen could be theoretically pretty bad for the company. And sort of the third element of this bear case, what if we never see WTI rebound? I think that's an interesting question. I don't know that we've asked that about a lot of these companies. What if we just see WTI sit in the 60 range forever? All of a sudden, all of that capital gain that we're sort of hoping for in the medium to long term doesn't happen. And maybe we keep getting the dividend, but there's not a lot of room to grow. You see $60 WTI. So are you happy with a stable 8% dividend for 5, 10, 15 years without any growth? Because maybe then there are other alternatives that are better, right? There are other companies that offer maybe not quite the same starting dividend, but greater growth or more capital growth, more sort of market cap growth, more share price growth, whatever it might be, right? If you're like me, if you're a pretty total return investor focused person, having the two, the dividend and the actual share price growth, is really important for that total return to make sense. So that's just basically my worries about the company, my bear case for the company. And I really do worry, like, what could we see in like a 2015 through 2021 scenario? What if we see another Canadian oil and gas winter, to use sort of a stock market term, where we see nothing happen, right? We see things just like grind down lower for the long run. I would personally probably be the kind of person buying back shares, you know, if I'm management, if I'm an investor, maybe I'm like reinvesting dividends. But that's a long time to wait on red numbers, right? Nobody likes to hold losses for that long. Maybe there are better opportunities elsewhere. That is the bear case. What do I actually think is going to happen? Obviously, it's going to be somewhere in the middle. It's going to be somewhere between, you know, share prices sort of rebounding and we see WTI up to 85 in a year and, you know, we're off to the races and everybody's rich. Probably not, right? Like, we're unlikely to see that in 2025. Maybe we see some, you know, oil price drop. Maybe we see a couple months of bad oil prices. Maybe we do see some recession numbers, right? Everybody's scared. We see, you know, Q2 through Q4 of this year suck, and then next year it's okay, right? We're probably somewhere in there. And so I think, to answer the question, is this a yield trap? No, probably not. But it is an interesting opportunity for a more risk willing to take or sort of risk on investor. I would say if you're a super conservative investor, if you're really risk conscious, if you don't like risk, if you're risk averse, there is some risk here. There's some real risk here, right? Nothing paying out almost a 10% dividend is doing that because it has no risk. Obviously, it presents a big risk. However, if you're willing to take that risk, there is huge potential here. I don't know that I would call it asymmetric, but in my bull case, you could be looking at huge returns. You could be looking at great dividend numbers. You could be looking at fantastic share buybacks, right? Like, this company has so much potential. They just need like one or two things to line up for them for us to see the next 5 years look fantastic for Whitecap. That's what I believe. That's who I think would be interested in this company. Maybe a more risk-taking investor who does love that dividend, who wants to grow that dividend. They're looking at 5, 10, 15 years. Right? I can't project out 20 years for this company. I don't know what that would look like for them, but they're looking at those next 5, 10, 15 years. They're willing to take maybe a 25 through 30% CAGR over the next 5 years share price and hold on to that dividend, see it grow by about 15%. You're getting those dividends right away, right? Not a guaranteed return. There's no such thing in the world, but you're getting a pretty safe return in those dividends. They're pretty well capitalized. They got some great free cash flow buffer space. We're going to see what happens in Q1, Q2, Q3, right? Maybe that free cash flow buffer starts to shrink. We're going to see what kind of decisions management makes. And then maybe you'll be able to make a safer decision in a couple of months. But right now, really interesting opportunity. Keep your eyes on this one. If you are a dividend investor, if you're interested in the Canadian oil and gas space, this is one to watch. A little bit smaller, a little bit more overlooked, right? It's a really interesting company. And a lot of you guys are already on this train. And even like huge names like Eric Nuttall is on this train. So keep an eye on this one. Let me know what you think in the comments down below. Do you think that I'm right? Do you agree that it's sort of an interesting opportunity, but maybe there are some elevated risks? Do you think it's a no-brainer? Should I be buying this right now, sell the whole portfolio and just YOLO into this? Or do you think that this is a total yield trap? Do you think that I am foolish for even considering this? Do you think that WTI is dropping? Just let me know. I'd love to hear from you guys. Let's start a conversation in the comments down below. And again, if you made it this far in the video, please do like the video, subscribe to the channel. It makes a massive difference and it doesn't cost anything. And with all that being said, I hope I see you in the next one.